Hello, and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source. Joining me today is Rob Romano, our Director of Research. Every time you turn on the news or listen to the radio or flip through screens on your web browser, you're going to see signs that our inflation has reached a 40-year high and stock markets have reached new lows. It's been a really tough year for investors. And so the common questions we're getting are like, have we seen peak inflation? Are we at the lows for the stock market for the year? Rob, let's start with inflation, where there's some interesting data we've started to receive. So what are some of our thoughts on what we're seeing in regards to inflation?
Thanks, Paul. Yep, we are seeing some evidence that inflation is peaking here, especially when we look at commodities. So like hard commodities, that would be your metals. So think of copper, aluminum, and steel. Those are rolling over pretty hard, and I would put lumber in that category. Lumber's retraced 2 years, pretty much of the entire move there. Other areas where it is elevated are apartment rents, and on this graph here, you can see the line graph for apartment rents from the lower left to the upper right, and see how apartment rents have remained elevated and have increased significantly historically. The other line graph there is the metals coming down significantly and rolling over. That's the London Metal Index. When we think of the soft commodities, that's more of your agriculture commodities, so corn, wheat, and soybeans. Those are down from their highs, but nowhere near where the metals are right now. In energy, it's a bit of a mixed bag. The price of a barrel of oil topped out at 128. Now it's closer to, roughly around 97. The good news here, and you can see it on this graph, is the rig count is way up. And so in the past year and a half, we've added a number of rigs that are out there pumping oil, increasing oil supply. So with this inflation, it has put consumers in somewhat of a pessimistic mood. And in June, we received the University of Michigan Consumer Sentiment, and it was at a record low. And Paul, the data series goes back to the mid-1970s.
And we know the 1970s wasn't exactly a great time for the consumer or the U.S. economy. So clearly challenges are faced by the consumer and the investor right now. Two of the things we like to watch is the Federal Reserve and what they're doing with interest rates, as well as corporate earnings. Last week, we know the Federal Reserve raised rates 0.75%, the second time they've done that this summer, and they're going to continue to raise rates into the fall. So we know what they're going to do. The one thing that continues to be a little bit of a mystery and we're following very closely is corporate earnings. Yep. We're right in the middle of corporate earnings for the second quarter. Kind of what are we hearing and some themes for now and through the end of the year?
Sure. We believe there's two factors that really drive equity prices. One is the Federal Reserve, and two are corporate earnings. And right now with the Fed, the risk is that the Fed does too much, is that they raise rates too far. So currently they're not only raising rates, but they're also letting the balance sheet mature here. And they're doing it in a recessionary environment. And that is a sharp contrast to what they did in 2008 and 2020 when they were lowering rates into a weakening economy. Now with earnings, there's two big themes that are playing out. One is the strength of the U.S. dollar. And in this graph here, you can see that the U.S. dollar is at an 18-year high. So in times of volatility and stress, global investors will tend to gravitate to the safety of the U.S. dollar, and that's what we're seeing. With that, though, comes a couple issues for U.S. investors. One is it makes our exports more expensive versus our trading partners, and two, for U.S. companies that do business overseas, when they translate those sales back to U.S. dollars, it lowers the value of those sales. So we've heard from a couple of companies, Microsoft and IBM, and they both highlighted the strength of the U.S. dollar and the impact on their quarter. Second would be margins. 2021 was a record year for operating margins, but in 2022, we're hearing companies warn about margins and some of the escalating costs, especially around labor and energy, that are having them to reduce their guidance on operating margins. Walmart was one of them. here just this week. And part of their issue was sales mix and maybe selling more grocery versus durables, but they also highlighted labor cost and freight and logistic costs. So we expect to hear from more companies during this reporting season warn about potential margin compression. In regards to market bottoms, we're not in a business of calling market bottoms, but we've had one of the worst starts to the year this first 6 months than we had since 1962. So, we believe a lot of the bad news is in equity prices. One caveat to that would be if economic conditions and earnings would deteriorate further from here. We would likely see the market continue lower in that scenario. But right now, with valuations and how they've come down since the start of the year, we are looking for opportunities out there.
There will be some opportunities. We know there's always opportunities created by volatile markets, and especially when you're down 15 to 20% in a given year. Thanks, Rob, as always, for your comments. I will reiterate some of what Rob said in that we're not in the business of calling peaks or market lows. It's something that we will only see, and the market will only see in the rearview mirror. So we're clearly looking ahead and what we need to do to help our clients achieve security, build wealth, and realize their dreams. As always, thank you for the opportunity to serve you and your family, and have a great day.